Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we'll recap recent events, preview what's on the horizon, and share some interesting charts and market price action that caught our attention. We start this week with macro data. The chart above shows U.S. nominal GDP versus the federal funds target rate. The rebound in Q2 GDP data made nominal GDP slightly above the Fed funds rate. But as they say in hockey skate, to where the puck is going, GDP is a backward-looking measure that often gets revised. Our growth indicators continues to signal caution, and we expect the Fed to cut rates this year starting in September. Meanwhile, U.S. core PCE inflation, Fed's favorite inflation gauge, came in line with market expectations. As the chart above shows, core inflation has been trending down and moving in the right direction. The last 13 core PCE readings have averaged 0.168%, or 2.0% annualized. That's a lot of core inflation prints on target, and seems good enough for the Fed to shift its language. We expect them to adjust the language at the July meeting and signal a cut in September. Next, an interesting chart from Bank of America research. They show that the yield curve tends to steepen at the start of recessions. The current 2S10s curve is still inverted, and the recent steepening could be a sign of a slowdown in the real economy. Our forward indicators indicate a slowdown in the economy. Next on the S&P 500 returns this year was highly unusual, with the daily index returns have been muted and has been less than -2% or +2% the whole year. This often leads to index volatility to collapse and dispersion trades to do well. Last week marked a shift in this picture. We got the rotation, a record rotation in fact, as measured by the S&P versus the Russell 2000. When these rotations happen, you get index correlations goes up. The popular volatility trade selling index volatility could unwind. This year-long dispersion has been a popular trade, selling implied correlation, and that could potentially unwind. This week, we focus on Japan, where we have a Bank of Japan meeting. There are two important developments to pay attention to. Japan's GPIF is the largest retirement fund in the world, has a simple asset allocation across equities and bonds, split equally between the domestic and foreign markets. However, the recent outperformance of Japanese and global equities, along with the underperformance of fixed income, has meant the GPIF now has to rebalance this portfolio. As per policy, the portfolio review of 50% weighting between bonds and stocks, which are split between domestic and overseas, is done once every 5 years. And this year we will learn if they are changing this allocation. Any shift away from global to local assets and/or a move from equities to fixed income will have an outsized impact on global markets. Next, Japanese households have been long underinvested in financial markets by global comparison. The new Nippon Individual Savings Account, NISA regulations that took effect in 2024 are meant to change this asset allocation mix. With NISA's tax benefit incentives are meant to encourage the accumulation of long-term savings in financial market instruments. This year, Japanese households have been investing about 1.3 trillion yen, about $9 billion a month in mostly U.S. equities. The scale of this flow is humongous and has led to the depreciation in the yen. If we get a strengthening in the yen or a large decline in U.S. dollar, this flow can head back towards Japan and be a headwind for U.S. equity markets. Finally, a very interesting paper from Hendrik Bessemeender titled "Which U.S. Stocks Generated the Highest Long-Term Returns" caught our attention this week. It is a very short empirical paper, but we took 3 takeaways from it. 1. As we look at recent companies with history less than 5 years and compare to stocks that have been around longer, the annualized return comes down dramatically with time. 2. The table above shows stocks with highest return generated, and some of these stocks started in 1920s. However, none of these stocks are in another table, which highlights the stocks that were around for at least 20 years with the highest returns. 3. By construction, this type of research ignores survivorship bias, where it only includes stocks that survived this period, and there were many high-flying, high-return stocks that went out of business. That is all for this week. See you next week. This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are as of July 2024 and are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.